Dealing with uncertainty in risky situations is tough, and that's exactly what China's factory workers are facing because of Donald Trump's aggressive trade policies. With tariffs being raised back and forth, tensions between the U.S. and China have escalated, impacting hundreds of billions of dollars in trade and access to the huge U.S. consumer market. This trade conflict affects everyone, from investors to businesses and government officials worldwide. Chinese manufacturers know they need backup plans in case the situation worsens. Two things are clear. First, replacing the U.S. consumer market is crucial but very hard. Second, despite the chaos, most Chinese companies aren't rushing to move production to the U.S. Americans generally don't want manufacturing jobs like making spatulas. They prefer to buy finished products like hamburgers. Chinese factories now focus on short-term survival rather than long-term planning, which leads to financial losses and fewer clients. For example, some companies have seen a 20% drop in revenue this year, and even makers of niche products like incense for yoga studios have had to halt production. The tariff war has led to huge spikes in taxes on goods shipped between the two countries, although there have been some reductions. Still, Trump keeps threatening more tariffs, even targeting countries helping China avoid them. Trade between China and the U.S. has grown steadily over 25 years, reaching about $600 billion last year. But there's a big imbalance. China exports far more to the U.S. than vice versa, leading to a large trade deficit. While the U.S. claims tariffs are a way to fix this, Chinese manufacturers are confused by the aggressive approach, which makes selling to the U.S. more expensive and difficult. This situation means companies may have to lower prices, cut jobs, and reduce wages, hurting consumer confidence in China, which is already low due to a property market crisis. Despite these challenges, China's economy has still grown by 5.2% recently, and overall exports have risen, but deflation remains a problem, causing companies to hesitate on investing and hiring. Although China wants to shift towards a consumer-driven economy, it still relies heavily on manufacturing to meet growth goals. With the future of tariffs unclear, manufacturers and workers are stuck waiting and worrying. Exports to the U.S. are a small part of China's GDP, but when you factor in job losses and price cuts, the impact could be much worse, potentially triggering a deflationary spiral. Chinese companies are adapting by exploring other markets. Many have expanded production in countries like Cambodia and India to reduce risk. However, shifting focus to markets like Europe is tough because those markets are already well-developed and competitive. The U.S. remains the most attractive market due to its size and openness to new products.